Hello and welcome to our financial education workshop. We intended to have a live format of this workshop. However, due to the circumstances of the coronavirus, we felt the need to create a virtual one instead. My name is Jared Hall. I've been working at Harvest Investment Strategies for 6 years as a registered sales representative, and we're excited to bring you this new service offering from HIS. You'll notice I'm going to refer to Harvest Investment Strategies as HIS going forward, so just keep that in mind. I'm going to introduce you to my brother, Lee Hall, who's also my coworker and partner on this workshop. He's going to tell you a little bit more about HIS, where we started, what we value, and some of our capabilities. Please note that in addition to this video, there's also a couple of PDFs that are available for your viewing. One is a study guide that we've created for you to follow along with during this session. Fill in the blanks as we cover the different educational topics. And the other is just our official fee-for-service menu, which could help to glance at throughout the presentation. Lee, take it from here.
Thanks, Jared. We did choose a company name that was long and hard to say, so I appreciate you abbreviating it for us. Well, welcome and thank you for joining us. We hope that you and your families are finding ways to stay healthy and engaged during these difficult times. I'm Lee Hall, and I've been working at HIS for just a little over 10 years now. We're a family-run and owned business with locations in Northwest Arkansas and Central Arkansas. When HIS first began, our focus was on asset management, wealth preservation, and capital gains, and just overall investment returns. And while these are necessary, they're only a fraction of someone's financial well-being. As our relationships with many of our clients developed, we realized the need for financial advice included a larger number of topics than just what to invest in. Most people need a lifestyle assessment consisting of goal planning, budgeting, insurance, education, and financial peace of mind. During this virtual workshop, we're going to review some investing basics and then glaze over some financial planning topics. We grouped these financial planning topics into tiered service subscriptions for you to consider, and we hope to establish a relationship with you following the workshop where we can meet and be an asset for your financial future. We believe we have the knowledge, market experience, and financial tools to provide a comprehensive strategic plan for your success. And while these could be considered standard practices for many other financial planners, we want to differentiate ourselves by creating value that stems deeper than just dollars and cents.
Lee, how could a financial advisor add value in a way that stems more than just money?
Well, this is where we think that oikonomics comes into play. You notice that weird word down in the lower corner of the slide. Simply put, oikonomics is the study of the different types of capital, where capital is the power to perform useful work. As one of our many resources or tools, we refer clients to a book titled Oikonomics, where there is a deep discussion on 5 different types of capital and how they can help you organize and prioritize your life. Encouraging this type of thought process is one way we provide a deeper level of service than just money management. So Jared, walk us through the 5 different capitals.
Thanks, Lee. While we don't have them listed on our slides, the 5 capitals are something that we continuously discuss. The first is physical capital. Physical capital is your health and time, just physical well-being while you're here on earth, that you're able to complete work, build relationships, and enjoy your life. The next is intellectual capital. This is your ability to learn and retain knowledge. Examples of this could be your educational background or your industry expertise. Third is relational capital. These are the relationships that you've formed and any benefit that they could have by the time that you have invested in them. Fourth is spiritual capital. This is simply your belief system or your life guiding framework. It's basically your worldview. Lastly is financial capital. This is the one that's most common that everyone would have guessed. It's your assets, money, liquidity, and ability to purchase goods or services. The main idea behind oikonomics is studying how each of these capitals are intricately related in a kind of give and take system. Let me give you a brief example. You may decide that you want to go out to lunch with your friend, and while you're at lunch, you decide that you want to purchase the meal. You've just invested financial capital into relational capital. Another example might be that you decide to go to the grocery store and shop for your meal instead of going out to eat. Here you've just saved financial capital and possibly invested in physical capital by deciding to eat a healthier meal. The idea is that every decision we make in our lives somehow affects another portion of our life. These consequences can be either positive or negative. We hope this gives you a little insight into the depth of financial advising relationship we're envisioning and helps you understand how this could add value to your future. With that said, I'm going to briefly cover a few of our standard capabilities just to give a little more color on who Harvest Investment Strategies is. At HIS, we function as an independent contractor with a broker-dealer instead of having our client relationships owned by a larger entity. Basically, this means we have a larger amount of freedom in helping our clients decide what is best for them. And at the end of the day, you have a relationship with Lee and Jared Hall and not some brokerage firm like Edward Jones or Wells Fargo, where you could potentially be passed off to a new advisor and almost forced to transact business with a total stranger. In addition to functioning independently, we also have the licensing and ability to oversee the actual management of your assets. While some financial advisors are not securities licensed or trained and may only discuss larger planning ideas like budgeting, debt management, or retirement income projections, we have the credentials and experience to actually manage your assets. Essentially, we can select stocks, bonds, ETFs, and mutual funds for you and oversee the strategic process of investing them instead of hiring that business out to someone else to do it for us. And lastly, because we have a multi-generation company with over 30 years of building industry relationships, this means we have built a preferred network of industry experts on a referral basis. If you need a CPA, we have a relationship with one. If you need an estate lawyer, we have relationships with a few. Basically, we have a high degree of relational capital that we've invested in over the years that you can take advantage of. So now that you know a little bit more about what Lee and I do, it's time to get down to the nuts and bolts of this workshop. The goal of the workshop is educational in nature. We've heard through our conversations with many of you all that there is a need for simple financial education. The majority of you have discussed most of these topics before, but if it's not something that you're continuously reviewing, it's easy to forget, and anyone could use a refresher from time to time. We're first going to cover just some simple investing basics, followed by some financial planning cornerstones. Lee, why don't you go ahead and walk us through some investing basics, and I'll act as if I'm one of them viewing the workshop and ask questions for discussion purposes.
Sounds good. We hope this section will provide some clarity on common terms that are often confused with one another. And for those of you already tracking your finances for your families, we hope that this gives you added confidence. Hopefully, this won't be as taxing as helping your kids with their homework, which I'm sure none of you are doing that right now. We'll begin by reviewing account type. Account types are something that people often confuse as an investment. Account types simply show who owns the account, the tax ramifications of that account, and what assets are allowed to be held inside that account, while the investments are the actual holdings within the account. These could be stocks, bonds, or mutual funds. We hear people mention the two terms synonymously, asking questions like, should I invest in my 401k? When really, the investment may be in a certain company's stock, and the 401k is simply the account type that the assets are held inside of. Common account types are checking and savings, which most people are very familiar with, IRA, which stands for Individual Retirement Account, Roth IRA, trust accounts, or joint accounts. It's also very common to see joint checking accounts and trust checking accounts.
So you're saying that I could have a joint checking account with my spouse, and I could also have a joint investment account with my spouse, but I couldn't have a joint 401k?
Exactly, yeah, you've got that right. I think you'll understand it a little bit better once we switch over and begin talking about investments. Investments are generally considered anything other than cash. Stocks, bonds, ETFs, and mutual funds, and even real estate. Each of these investment vehicles carry different degrees of risk, and they also have different objectives that are associated with each one of them and how they return funds.
Great. So Lee, why don't you explain to me the difference between stocks and ETFs? I know I've heard those before, but I don't quite know the difference.
Yeah, so a stock is a share of a company that investors are able to buy and sell. And then an ETF, which stands for Exchange Traded Fund, differs from stocks because you aren't purchasing a share of one company, but a share of a fund that owns a basket of stocks. Essentially, ETFs are more diversified than a single stock and managed by fund companies trying to implement a particular strategy. ETFs might follow a commodity like gold or even a sector like retail or technology.
Okay, so what about the difference between ETFs and mutual funds?
So the main difference, that they are very similar, but the main difference is that ETFs are going to trade on a tick-by-tick basis, very much like stocks do, whereas mutual funds, even though they're kind of made up the same way by a fund manager, You can only trade those by placing orders and then executing at the net asset value price at the end of the market trading day.
Gotcha. Okay, so stocks, you're going to own just one company, and ETFs and mutual funds, you could potentially own a plethora of companies.
Exactly.
Okay, cool. What about the difference between a bond and a stock?
So that's a great question, and I think we'll shed some light on that as we go to the next section and talk about how investments make money. There's really two ways that assets or investments make money, which will help in just your overall understanding. The first way that assets make money are capital appreciation or capital gain, and the second way is a term called income. Adversely, there's only one way to lose money or return, and that is through capital depreciation or capital loss. Capital appreciation and depreciation are fairly simple concepts. When you own something and then sell it for more or less than you paid for it, you have a capital gain or a capital loss. An example would be if you purchased a widget for $10, a year later you sell it for $20, you made $10 in capital appreciation and a total return of 100%. The second way that we mentioned a second ago to make money is through income. Income is any excess cash flow that an asset can provide and pays out to the owner. The most common types of income are dividends, interest, and rental income. And so this kind of brings us back to your question, Jared, about the difference between stocks and bonds. Stocks work by issuing shares to the public for sale, becoming partial owners of the business and entitling them to the potential gains or losses the company may experience, as well as any excess profits paid out in the form of dividend income. Bonds are offered by those needing a loan. These can be issued by corporations, municipalities, or even the federal government. And investors may lend money by purchasing these debt securities. In return, they receive income payments back and their principal back at the bond's maturity. When you, as an investor, net out your gains or losses, which both stocks and bonds are susceptible to, along with any of the income you may have received, you get the term total return, which is commonly confused with the term interest rate. People incorrectly assume that stocks and bonds make return in the same way, commonly asking us, what sort of rate can I expect from my investment account, as if it were a set outcome that repeats every year. Interest rates received on a loan don't fluctuate. However, total return can vary greatly depending upon any capital appreciation or depreciation.
Okay, so I think I'm beginning to understand. Bondholders are just debt obligations, while stocks are actually ownership or equity of the company. So what's the difference in risk between these two types of investments, and how do you guys assess how much risk I should or shouldn't take as your client?
First, let me address risk in more general terms, and then I'll get more descriptive, Jared, in talking about how we assess the risk between the two different investments. The bad news is that every asset has a risk involved. Even cash, which is a relatively safe asset, has inflationary risk and depends on the full faith and credit backing the bills. So one way we assess risk is through a series of questions called a risk tolerance questionnaire. These questions form a risk score that we use to advise you, the investor, on the investment types and investment concentrations. The chart that you see here is actually a piece of one of our risk tolerance questions, and it illustrates a couple of ideas. It sets up a scenario of an investor with $100,000 to invest for 1 year. Then it's going to show the given outcomes that the account could provide, and then we ask people, at what outcome do you begin to feel uncomfortable? This represents the amount of risk you are willing to take. Now you'll notice that as the graph goes down, you're going to see the blue bars increase quite rapidly, and those blue bars are going to represent your potential capital appreciation or capital gain. And the red, adversely, is going to reflect your potential for loss. And so it reflects the overall idea that the greater risk that you're willing to take, your potential for greater return is there, but so is the potential for greater losses. The risk tolerance questionnaire is just one tool that we use to assess and analyze risk, and the other ways that we do it is just going to be conversationally getting to know you guys, looking at what you have told us is important in your lifestyle assessment, and just making sure that you have a grasp of how investments fluctuate, and that which ones you're going to be more comfortable owning over time and accepting the given risk levels. To answer your first question about which are more risky, stocks or bonds, the general rule, Jared, is going to be that stocks ownership has a higher degree of risk due to the order in which businesses, spend their revenues. They have to pay their bills and their debt obligations first, then they need to pay their employees, and then shareholders are just going to get paid last or have the potential for returns out of earnings.
So you're saying that if a company was about to go bankrupt and things were looking really grim, that the shareholders would be the ones left holding the empty bags, that they would be the ones left out of the party?
Exactly. And stocks are also going to see price fluctuations that happen more rapidly and with greater variance than bond prices, which also leads to a higher degree of risk.
Yeah, that makes sense. I mean, when I turn on CNBC TV or watch the news, they're always talking about stock prices going up and down and not really talking about bonds that much. So, yeah, that makes sense. So go ahead and explain this quote for me.
Yeah, this is a great quote. Risk is often not perceived until losses are incurred. The way we explain this one is through a simple analogy. If you were a kid and bought your first bicycle, if you didn't buy a helmet and use it, the risk that you were taking is not perceived until you crash and crack your skull. Only when you've hurt yourself do you realize how dumb you were for not wearing a helmet. And the same applies to investing. You're typically only going to realize your risk when the losses start adding up, which is no good. And now that we've covered, at least on the surface level, many investing basics, we're going to transition into how HIS can add value for a client in some other areas.
Thanks, Lee. Yeah, I'll take it from here. So staying in the financial capital space, if we think back to economics, one way that we can provide value for you is through strategic oversight. When we think of strategic oversight, we're talking about active management. This is literally placing trades week to week or month to month, depending upon the market backdrop and business outlook. Active management is a great value for someone who's searching for protection during market turmoil or who's trying to capitalize on a niche industry movement. However, not all of our clients need active management. The other is passive. Passive management is more simplistic because investments are selected with the intent of holding on to them for years into the future or at least months at a time. There's been a continual debate, which you've probably heard of for years on this, about which one is more effective. We find that the truth often lies somewhere in the middle, and that at certain life stages or for different pockets of money, each strategy could be necessary at a different time. So now let's transition a little bit further into financial planning, which will be moving into an area where we can provide the most relational, intellectual, and physical capital value for you. This is where our new service offering will be unveiled, and where we will kind of hold your hands through many of life's tough decisions.
Whoa, wait, Jared. Hold their hands. I don't think we're going to be allowed to do any of that at the moment.
Yeah, I guess you're right, Lee. I meant where we will discuss different topics about how our team can provide guidance, resources, and decision paths to lead our clients towards financial peace. I've realized through many of conversations that I've had with you guys that there is a need for goal planning and goal generation. Most of you are asking me questions like, I don't know, should I prioritize saving for a down payment on a house? Or should I prioritize upgrading my vehicle? What about putting money in the stock market? Should I go to graduate school? How much should I save towards goals? What if I'm trying to start a business or launch my career that I don't really know where I'm going or how to get there? All these questions are appropriate and serve as evidence that there's a great need for assisting you all with goal planning. As part of our process here at HIS, we have you fill out a lifestyle workbook that helps you prioritize your goals. It's a homework assignment we give you chock full of thought-probing questions about retirement, savings, career, marriage, travel, lifestyle choices like owning a home or leasing a place, and even large purchases. We utilize the information to help you prioritize your life, and often we find that simple topics on the forum help people think of goals that had perhaps slipped their mind. Depending on what life stage you're in, part of our value is serving as a mediator or moderator between you and your spouse, encouraging you to continue your conversations about money. Lee, you've been married for 3 years, so maybe you can shed more light on this than I could.
Yeah, and we're actually closing in on 4, so pretty proud of that. One of the primary focuses in any premarital class that I know of is on finances, and that's because stress and disagreements about household finances is a leading cause of marital and household frustrations. Household finances are typically a difficult subject to get on the same page as with your spouse because we all have different experiences that shape our expectations pre-marriage. So one tip through experience with my wife, especially around budgeting, is to maybe have a set time and place to discuss spending and goals rather than while you're opening up that bill.
Yeah, that seems like some solid insight into mitigating those potentially conflict-oriented conversations. Sounds like it's better to be proactive about them instead of reactive with them.
Definitely.
You'll notice on the slide that we have a lot of different quotes that kind of force you to think about your own financial goals. If you use the handout that's also attached in the document, you'll notice that a lot of these questions are similar, and they're just really designed to get you to consider your own finances and your own goals and to be honest with yourself on how you're pursuing those. Heading to our next pillar, if you will, of financial planning, we head into budgeting. Budgeting, we're going to break down into two sections: fixed expenses and variable expenses. The majority of you could probably give me a rough estimate of your fixed expenses. You know, your mortgage, your utilities, your internet bill. Perhaps you could give me how much you spend on gasoline or food. But your variable expenses are the ones that maybe you couldn't keep track of quite as well. For example, how much do you spend when you go out to the bar? How much do you spend at restaurants? What's your shopping bill like? Sometimes performing an honest budget assessment takes someone else's help. That's where we can provide value for you, asking the tough questions that sometimes you don't want to ask yourself. We know it's a hard process, but it must be done in order to reach certain goals and set yourself up for financial peace. Next up, and of great importance for you young professionals out there, as opposed to some business professionals who have had years of experience with this, we're going to talk about retirement accounts a little bit more in depth. Now, we covered these a little bit in our educational session, and we kind of talked about the different account types, but we didn't discuss which one would be right for you. Part of our value and the process that we'll go through is sitting down and looking at your 401k options with you that your company offers. They may even offer a Roth IRA or a Roth 401k option, but you don't know all the limits that qualify you for those accounts. One thing we'll do is sit down, we'll look at your income, we'll decide which account type is best for you, which one suits your needs, which one will provide you the most benefit, and we'll even deep dive into those to see what assets and what investments are making up those accounts to make sure that you're investing in the right manner and taking full advantage of your company's participation in that account. If you're already completely confident in your 401k options, then you may be looking towards the next tier on the financial service offering. This could be the business professional tier, where you might need help setting up a SEP IRA if you're a business owner, or even trust documents if you have large estate or tax implications for assets that you've accumulated throughout your career. You'll notice as we finish up discussing the different pillars of financial planning that several of them kind of apply to which life stage you are at. That leads us to our next pillar of insurance. There are many different types of insurance, and all of them have their certain uses. You've probably heard of term insurance, whole life insurance, or even key person insurance if you're an entrepreneur. Part of our process at Harvest Investment Strategies is walking through your need for insurance. This is an insurance needs analysis. So depending on what life stage you're at, maybe you have kids or you're caring for disabled parents, maybe you own a business and you're the only person that can complete the day-to-day operations, or maybe you're just the sole breadwinner, you can most likely utilize some sort of insurance analysis and protection. And if you're not there yet, a general education session on insurance is great so that you can plan for your future. One function of insurance actually intertwines with our last pillar of financial planning, and that's continuity. Lee, I'll let you take this one. When we think of continuity, what are we considering?
Yeah, continuity as a concept is how to plan for potential worst case scenarios or how to take care of loved ones after we're not able to. It's great for individuals to have an emergency fund or for when times when paychecks aren't there or if medical issues arise to ensure that your lifestyle can continue. And it's great for businesses that need operations to continue no matter what. For example, key person insurance involves planning for the continuity of a business should a key person leave or be unable to assume their duties, which illustrates how closely linked continuity and insurance analysis can be. And now that we've covered some pillars of financial planning, the next step is going to be to build a relationship with you. At HIS, we desire to be problem solvers rather than product salesmen, and we'd love to schedule an introductory meeting where we could explore your needs and get to know you more personally. Please note that in order to keep this workshop within a considerate time frame, we only discuss topics broadly with the hope that you are thinking of your own situation and how we might serve you.
Absolutely. That's the thing about financial planning, is that it's not a one-size-fits-all, and we look forward to meeting you. Please note our fee-for-service PDF is attached on our website for more information about the different services that we can provide, the fees associated with them, and which tier of subscription might fit your needs best. Also, to help you manage your expectations and give you an idea of what the process looks like in person, we created this flowchart of a mock relationship. We begin with introductory meetings for people to give them an insight as to what services we can provide. Then we move into the lifestyle guidebook, goals, and risk assessment. As you can see, the natural flow of meetings follows the different tiered offerings of service. These are rough suggestions. What I mean by that is if it takes more than one meeting to give you confidence on your goals or your budget or even your 401k allocation, we will spend the necessary time to put your mind at ease. Thanks for bearing with us through these unprecedented times. We apologize for having to make this a video format, but again, we hope you all are staying safe and healthy. Keep up to date on our website where we post a plethora of financial articles as well as a market blog. We hope you share this presentation with others, and we hope that you find benefit in it. Thanks.